I'll be the first to admit and tell you that the stock market isn't connected to the real economy. But if the environment as a whole isn't doing well, then it will be a headwind. It's going to be hard to do. There are 3 reasons why stock market is crashing. Hello everyone! Welcome to Success Wisdom. In this video, we're going to talk about why stock market is crashing. An explanation. If you are new to this channel, do like and subscribe to the channel. There are 3 reasons why the stock market is going down. First, if inflation stays high and interest rates go up, this will hurt the stock markets. Second, the PRE ratio needs to go down. Mean reversion is what we're seeing right now. This is when asset prices return to their long-term averages. In this case, it will be the price to earnings ratio. Third, it's the big picture or macro environment. First, we'll talk about inflation and interest rates. Again, I'll explain this as if you know nothing about the stock market or are just starting out. There's nothing wrong with being a beginner, and this is a great place to learn. If you're an investor with some experience, I'll probably fill in some blanks for you. If you're an experienced investor, this video won't teach you anything. Let's start by talking about inflation and interest rates. We all know that inflation is at a very high rate. It has gotten faster than it has in 41 years, which is nothing to be proud of. The Federal Reserve is raising interest rates to make up for this. So, if you raise interest rates, the economy and demand will slow down, which will slow price inflation. If interest rates go up, the money you earn in the future will be worth less. This is why the stock market is killing growth stocks and tech companies that aren't making money. I'm going to make this easy to understand. I think giving you an example is the best way to show you what I mean. So, let's say you have the chance to buy a business for $2 million and you know that if you do, you'll make $200,000 in 10 years. So, I'd like to know how much interest most people get on their savings accounts. So you put $1 million into the bank. The interest rate for most people is less than 1%, which is very close to zero. You aren't getting any money from interest. So you put $1 million into the bank. How much money will you make? How much money will you make in interest over the next 10 years? So it will be close to zero in this case. So in our example, if you buy this company for $2 million and expect to make $200,000 over the next 10 years, that seems like a better choice than putting your money in the bank and getting nothing in return. The company's future earnings sound pretty good, but the whole story will change if the interest rates changes. For example, if the interest rate on your savings account goes up to 5%, the company's future earnings will no longer be as valuable. In this case, you can put your $2 million in the bank and earn $100,000 in interest each year. After 10 years, you will have earned $1 million in interest. That leaves out any addition. So in this case, the future earnings of this company sound like a terrible investment at a time when interest rates are high. If interest rates go up to 5% in this example, I won't be willing to pay $2 million for that company, but I will be willing to pay for $400,000. This is because if I pay for $400,000 for that company, it will make me $200,000, which is a gain of 50%. So, if I put $300,000 into something, I would get back $300,000. I make $150,000. I mean, what else could we do? I could just put $2 million into my savings account that earns 5% and get back $1 million, which should be a 50% gain. Of course, that's not the whole story, but that's the main point. When interest rates go up, it will lower the value of future earnings. And what's the deal with growth stocks that don't make money? They are losing money right now, but they say they will start making money in the future. This is why they are called growth stocks or tech stocks that don't make money. they are getting destroyed more quickly than others. So I do want to say that some stock like financials will do better when interest rates go up. But don't run out and buy financial stocks right after watching this video, because the market is forward looking and people have already thought about this. Anyway, that's value for the future. For beginners, present value, the value of money over time, discounted cash flows, and the cost of not taking an opportunity are shown for beginners. If you like this video, don't forget to like and subscribe to the channel. We will now proceed on to the next reason why stock market is crashing. The second reason is that the P or E ratio must return to its long-term average. I'll explain this in a way that's clear and easy to understand. The P or E ratio is a way to figure out how much a stock is worth based on how much it makes per share. So, if you get an offer to buy a business for $100 and it makes $10 in profit every year, the P or E ratio will be 10. A P or E ratio of 10 means that the price is equal to $100 divided by $10 of earnings per year. When a P or E ratio is high, it usually means that the stock is overpriced. So if you get an offer to buy something for $100 and they make a profit of $1 per year, the P or E ratio will be $100. If the P or E ratio is low, it would take you 100 years to get your money back because you only make $1 a year. It's usually thought to be undervalued. So if you get an offer to buy a business for $100 and they make a $50 profit every year, it would take you 2 years to get your $100 back from the P or E ratio. So now that we know that, let me tell you the numbers. The S&P 500 has had a P or E ratio of 13 to 15 in the past, depending on the year or time frame you look at. The S&P's P or E ratio for the last 100 years is 19. The S&P ratio will be around 20 in the second quarter of 2022. Since the P or E ratio has been falling from above 30 for the past 2 years, we're just getting back to the average. You might think that since we're getting close to the average age of 19, the crash is over. But I wouldn't be so sure. If companies are making less money, their earnings will go down, which means that the P or E ratio will go up, which means that there could be more risk to the downside. In the end, the P or E ratio was just too high. When the stock prices fall, the P or E ratio is going back to what it was in the past. Third and the last reason why stock market is crashing, you need to pay attention to what's going on in the macro environment. What does it mean that a rising tide lifts all boats? All of you who invest in cryptocurrency, you know this. You've been through this. If the price of Bitcoin goes up, almost all other coins will also go up. If Bitcoin is doing well, crypto will do well too. If Bitcoin is doing badly, cryptos will do well. The same as if 90% or more of all coins go down when Bitcoin goes down, when you need to pay attention to what's going on with Bitcoin when you buy or sell altcoins, even if you're not investing in Bitcoins. So the same thing will happen with the stock market. And I'll say it again. I know that the stock market and the real economy aren't connected. However, if the real economy isn't doing well, the stock market will have a hard time. If the Federal Reserve doesn't step in and start printing more money, don't fight the FED has been a common phrase over the past 10 years. Most people know that the Federal Reserve has been printing so much money that it has flooded the system with so much money that the prices of bonds, stocks, and basically all other financial assets have been going up. When there's so much money in the system, you have to put it to work somewhere. But now it's the other way around because the Federal Reserve stopped printing money 2 months ago. The party is over, but there's more. It's just going to get worse because the Federal Reserve printed so much money. Things are only going to get worse. In the next 3 months, they will start taking that money out of the system. They're going to take back $47.5 billion a month and then $95 billion a month after that. So don't fight FED. I do want to make something clear. In our money system, the Federal Reserve doesn't really like to print money. Lending creates money, so the US government prints money by spending more than it takes in. And banks lend money into existence. But the Federal Reserve is basically in on the plan. In short, they are making money out of thin air. Quantitative tightening is what the Federal Reserve is doing, and the interest rates are going up as a result. Stocks, bonds, and cryptocurrencies will all be hurt by this. I hope this clears up what's going on for you. We've reached the end of another video and thank you for watching. I hope you have learned why stock market is crashing. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye!